Welcome to my channel, Learn and Earn, to live your life on your own terms. Hello everyone, you're welcome to my channel, Learn and Earn Academy. And today in this video, we are going to talk about non-performing asset or NPA. Now, this is a very important subject, especially for bankers and the people who are appearing for bank exams. So in this video, we will talk about all the aspects of non-performing assets. In this one video, will clear your concept of NPA forever. Now, according to Reserve Bank of India, the gross non-performing asset in Indian bank in public sector is around 4 lakh crores, which is around 61.5 billion, which is around 90% of the total NPAs in India, where the private sector forms the remaining 10% of the NPA. So if you have to talk about NPAs, 90% of NPAs are because of public sector bank and 10% of NPAs are because of private sector banks. So I hope this point is clear. Now let us understand what exactly is NPA. Now normally we know that banks provide money or assets in form of loans, and sometimes this loan is not paid by the borrower. So bank is giving loan to the borrower and the borrower is not paying the loan. Now the late or non-payment of loan is defined as non-performing asset. So there are certain parameters based on which a loan is classified as non-performing asset. So the basic concept is, if a bank has given loan to a borrower and the borrower does not pay, the loan account becomes NPA, also called as bad asset. So I hope this concept is clear. Now let's go to the next point. In India, RBI monitors the entire banking system. We all know that RBI is the Central Bank of India. So any loan which is not paid for a period of 90 days or more than 90 days, the interest or the installment overdue is called NPA. So any borrower who has taken a loan from a bank and does not pay for 90 days, his loan account will become NPA. I hope this concept is clear. Now, the increase in non-performing assets in Indian bank follows the recognition standards being pursued by the banks after the RBI highlighted in asset quality review. Now, in the last few years, RBI has come up with strict measures to identify bad assets. Because if you want to improve the quality of banking in India, you need to come out with the shortcomings. You need to come out with the problems. And the biggest problem in the banking industry today is non-performing assets. So what the banks were doing earlier, they were not classifying NPAs proactively. They were hiding NPAs. But RBI came with asset quality review, as per which RBI recognizes NPAs in a very transparent manner, in a very open manner, in a very strict manner. So I hope this concept is clear. So RBI is the institution which is responsible for classifying loan accounts into NPAs. Now, what are the reasons for rise in NPAs? Now, this is a very important concept which we all need to understand. Now, from 2000 to 2008, Indian economy was in a boom phase, and banks, especially public sector banks, started lending extensively to companies. Now, what do you mean by a boom phase? Now, boom phase is a phase where the economy is growing at a very fast pace, where the economy is showing great GDP growth. And this was happening in India from 2000 to 2008. Now, the banks were very happy. And what they did, they gave loans to people proactively without doing much of credit appraisal and thinking about the future. Because during this time, everything was going well and the market was completely in an boom phase, in an excited phase. However, there was a financial crisis, and this financial crisis was reported in 2008 2009. Now, corporate profits decreased and the government banned mining projects. So, now what started was that the corporates were failing. The corporates had to close their business. Many projects were stalled. The situation became serious with substantial delay in environmental permits affecting the infrastructure sector, power, iron, and steel, resulting in volatility in prices of raw material and shortage of supply. Now, 2000 to 2008, for 8 to 9 years, there was a boom phase. Suddenly, in 2008, everything came down. There was a financial crisis. The situation became very serious. None of the infrastructure sectors was working. All the projects stopped. There was volatility in the prices. No one was ready to buy the prices. And even if someone was ready to buy the prices, it was at a very high cost. Suddenly there was shortage of supply. Now another reason is the relaxed lending norms adopted by banks, especially to the big corporate houses, foregoing analysis of the financials of the credit rate. Now, recent developments and way to tackle this problem. Let us see this important concept. Now, how this problem of NPA is being handled by the banks, by RBI, because we now know what is the problem. We need to find the solution. Now, I'm making this very simple for you to understand so that all your concepts are clear and you are able to answer any question on NPAs. Now, let's get back to the first step which RBI took: Insolvency and Bankruptcy Code. Now, the resolution process is expected to quicken while continuing to exercise control over the quality of asset. There will be changes in the provisions requirement with the requirement for higher proportion for provisioning going to make the books better. Now, what used to happen earlier is if a company or if an enterprise is not functioning well, it did not have a proper mechanism to exit. So, if a person is sick, he will become more sick because there is no way for him to get out of sickness. Similarly, the banks were also and the enterprises were also facing the same situation. There was no exit mechanism. If a company within the first 2 years of its opening is not performing well, it should exit the organization and so that the company does not make more losses. Because if a company or an enterprise make loss, it is a loss for the economy as well. The bankers who have given loan to that company will also suffer. But if there is a mechanism through which the company can declare bankruptcy, the company can say that I cannot continue the business because my business model is failed. So there is now a process through insolvency and bankruptcy code where you can exit a failing enterprise. So I hope this concept is absolutely clear. Now the second was credit risk management. Now this involves credit appraisal and monitoring accountability in credit by performing various analysis on profit and loss statements. Now RBI was very strict with the banks, and even the banks realized that if they want to sustain banking business, They have to do proper credit risk appraisal. They have to see all the aspects of the customer. They have to see whether the customer can pay, what is the intent of the customer, where will he make the profit from, how will he run the business. Earlier, these aspects were not seen, but now, because of credit risk management, all these aspects were seen by the banks. Now, while conducting the analysis, banks should also do sensitivity analysis and should build safeguards against external factors. Now, what is sensitivity analysis? Now, for example, a company comes to me for a loan. I am a bank. Now, what I will do, I will analyze, I will assess the next 10 to 15 years performance of the enterprise who has come for a loan. How will I do that? I will do projections. I will assume. I will make calculations. I will take certain assumptions based on which I will extrapolate and will get the next 10 to 15 years of performance of that enterprise if everything goes well. This is called sensitivity analysis. And I will also build safeguards against external factors. This means that I will have proper reserves in case the enterprise fails. I should be able to sustain my bank. The next step was tightening of credit monitoring. A proper and effective management information system needs to be implemented to monitor warnings. The MIA should ideally detect issues and set off timely alerts to management so that necessary action can be taken. Now, earlier this was not there. Now, all the banks are playing a very important role in monitoring the credit. Even after you have taken loan from the bank will continuously see your performance, how much you are earning, are you able to make payments, how much profit or loss you are making in your enterprise. And if there is any warning signal, they will be alerted and they will accordingly try to handle the situation. Earlier, these things didn't used to happen, but now, because of RBI's initiative, all these steps have started. Now, the next step is amendment of banking laws to give RBI more power. Now, the present scenario allows the RBI just to conduct inspection of a lender but does not give them the power to set up oversight committee. Now, with the amendment to this law, RBI will be able to monitor large big accounts and create oversight committees. Now, the government has realized its mistake. The government has realized how important it is for RBI to regulate the lending, especially to big corporate houses. Earlier, the only job of RBI was to do inspection of the bank. But now, the RBI has the right to monitor large big accounts and create oversight committee. So I hope this point is absolutely clear. The next is more haircut for banks. Now, for quite some time, public sector undertaking lenders have started putting aside a large portion of their profits for provisions and losses because of NPA. The situation is so serious that RBI may ask them to create bigger reserves and thus report lower profits. Now, what do you mean by haircut? Now, every company or organization either makes profit or loss. So, if a company is making profit, it is doing good. Now, haircut means that out of the profit, you take out some amount from that profit and keep it in reserve as a cushion. In case something goes wrong, this reserve can be utilized. So slowly and slowly, RBI is asking the companies, the enterprises, the public sector units to do more haircuts, to bring more money from their profit and keep it as reserves so that any unfortunate circumstances can be handled in a much better way. Stricter NPA recovery. Now, it is also discussed that government needs to amend the laws and give more power to banks to recover NPA rather than play the game of wait and watch. So, I'm sure we all know that the recovery process of the banks has become more strict and the banks are very proactive in recovery of the NPAs. Next is corporate governance issue. Banks, especially the public sector ones, need to come up with proper guidance and framework for appointment to senior level position. Now, earlier, the appointment to the senior level position at the level of executive director, at the level of CEO or chairman of the bank, was done on a very random and unpredictable way. But now there is a proper framework for appointment to these senior level positions. Now, this has brought accountability, transparency, and there is, in fact, no scope for corruption. Now, the next important step which the RBI has taken is accountability. Lower level executives are often made accountable today. However, major decisions are made by senior level executives. Hence, it becomes very important to make senior executives accountable if Indian banks are to tackle the problem of NPAs. So, after the government has made several changes in the way that NPAs are to be recovered, they have created more accountability. Every level has to be accountable to whatever actions they take. So, if I am a chairman and if I am taking a decision at my level, I will be accountable for the decision which I am taking. So this has ensured more transparency and the the corruption incidents have reduced significantly. Now the bank should also consider raising capital to address the problem of NPAs. The more capital the banks have, the more cushion they have against NPAs. So if there is an NPA tomorrow, the banks will have reserves or capital to handle the situation. So how it can be done? Now let us discuss some of the ways it can be done. By using unclaimed deposit. Now similar to provision of unclaimed dividends, the government may also create a provision and transfer unclaimed deposit to its account. These funds in return can be transferred to banks as capital. Now we all must have heard about dividends. It is the profit percentage which you get if the company in which you have invested makes good amount of profit. Similarly, the government may create a provision and can transfer the unclaimed deposit in its account, and this fund can be used for the banks as capital. So this is one way to increase the capital of the bank so that they can sustain any unforeseen circumstances. Next is monetization of assets held by bank. Now in this case, banks with retail franchises should create value by auctioning a bank assurance association rather than running it themselves as an insurance company. The current step blocks the capital inflows and doesn't generate much wealth for the owners. So any asset which the banks has should create value. And what now the bank does, it tries to find association and run the assets which where it can generate profit. The third way is to make cash reserve ratio attractive. Now, at present, the RBI asks Indian banks to maintain a certain limit on CRR, which on the RBI doesn't pay interest, and hence banks lose out a lot on interest earning. Now, if the CRR is made more financially rewarding for banks, it can reduce capital requirement. So this is another way of improving the capital of the bank. Refinancing from the central bank. The US Federal Reserve spent 700 billion to purchase stress assets in 2008 and 9 under the Trouble Asset Relief Program. Indian banks can adopt a similar arrangement by involving the RBI directly or through the creation of special purpose vehicle. Now this can be another way of reducing the uh, NPAs and also increasing the capital. What the RBI does in association with banks or create a special purpose vehicle is to buy all the NPAs and compensate the banks. So you are taking all the NPAs from the books of the banks. So the banks are becoming healthy. And in a way, you are compensating them by infusing capital. And hence, you are improving their performance. The fifth and the last way which I would want to discuss with you is structural change to involve private capital. The compensation structure and accountability of banks create a problem for the market. Banks should be governed by board while aiming to reduce government stake and making the financial institutions attractive to private investors. Now we all know that if you want to exceed in business, the private players not only bring expertise but also better way to do business. Similarly, there should be structural change and bring in the government organizations and more private capital should be infused so that not only money comes in but also fresh ideas, innovative ways to do business comes to the table as well. So, with the potential solutions above, the problem of NPA in Indian banks can be effectively monitored and controlled, thus allowing the banks to achieve a clean balance sheet. So, I hope this video would have given you all the information and would have cleared the entire concepts on NPA. So, if you like this video, you can press the like button, subscribe to our channel, and share it on social media. Help us to spread education in this beautiful world. Thank you.